strong job market provides a really solid foundation for housing this spring. And let me show you some numbers along those lines. So employment continues to remain strong. And this is, as I said, 9 months into the worry that, oh, we're going to hit a recession any month now. Employment remains resilient. The number of job openings, though getting smaller, is still significant, which tells me a lot of companies still need workers.
Because the management and transparency is what's very important. So once you submit a referral, you're going to have your own Home Advantage account, and it's going to tell you where everything sits. So if you have 10 referrals that you've sent into the network, it's going to give you all 10 referrals. It's going to tell you every milestone that that client is sitting in, whether they're touring homes, whether they're in escrow. And you now can manage through the Home Advantage application as far as what your pipeline looks like for the referrals that you've sent. And so it's pretty sophisticated, and it's all click of a button, guys.
Welcome to this week's episode with Keeping Current Matters, where we talk about what's happening out there in the real estate world from an economic standpoint, so we can really truly understand the market, what's happening with the market. Even though we don't have a crystal ball, we can start to see maybe where it might be going. And we're here with a very special guest, one of the people that look at this data, put the data together, and translate it from Economist to English. And we're here with Chief Economist of Keeping Current Matters, George Ratiu. Did I say that right, George?
Absolutely, Johnny. Right on.
Awesome. Well, thank you for being here. I'm excited to hear about the conversation coming from your mouth, because often we hear it being relayed or parroted through somebody else. So hearing it directly from you, the person that looks at it and says, this is what we think, this is what the graphs mean, this is what these numbers mean, and taking a deep dive into that. And you're going to be talking to us about what's driving the spring market and the things behind that, right?
Absolutely. Absolutely. And especially since we really find ourselves, 8-9 months now into a cycle during which we've had headline after headline after headline saying, hey, the economy is going to fall into a recession any month now. We're still waiting. The housing market is going to crash and burn, and prices are all going to fall, and we're going to have a repeat of 2008 or 9. So, right, this is what we've seen, and yet month after month we're looking at the data, and it's not exactly that. So, exactly to your point, that's what I'm looking forward to chatting with you and the audience today.
Yeah, awesome. And there's a whole lot of people out there that have been waiting for that to happen. And I simply look at that as intermediate person of the real estate market and everything that drives it, and the economic factors and the factors that made that 07-08 crash possible just don't exist. They have been removed. Of course, there's always going to be something else. So I don't think we'll have a repeat of that, because they have become a little bit more stringent on the lending guidelines. For one in particular, no more buying 3 or 4 homes with fake documents, if you would, or breaths of fresh air. You actually have to prove and validate your information, which I think is a great thing, which I don't think we're going to have that same crash. If we have a crash, I'm more thinking it's going to be a global crash. But I don't think about those things. I don't worry about those things. All I have to deal with is today. And today you're going to give us that information. So what are you seeing, man? Floor is yours. What do you want to tell this good world?
All right. Thank you, Johnny. And I agree with you. Yeah, for a lot of dooms, sayers out there who have been calling for a housing crash, I think they're really misreading, number one, market fundamentals, and I'll chat about those in just a moment once I start some of the slides. Number two, exactly as you pointed out, the financial environment. Both of those are different. We're not in an overbuilt situation like we were in the mid-2000s, number one. Number two, to your point, a lot of legislation and regulations put in place in the wake of the last housing crash have meant, number one, a lot more documentation required for a loan. Number two, a lot tighter underwriting. So FICO scores, credit worthiness, all of these have been really ratcheted up. So today's buyers are in a much better position to move into the market. So with that, let me, if you don't mind, I'd love to share the screen, and probably I would need from you to just either make me a co-host so I can share the screen with the audience, if you don't mind. Excellent, thank you. And I am going to hop right into the slides that I prepared to share with you today. So the first thing I want to really delve into today is exactly as I pointed out. In the wake of 8 or so months of gloom and doom expectations, what's the spring market really look like on the demand side? And here's some data from ShowingTime looking at foot traffic. And as you can tell, right, in the wake of the mortgage rate increases last year, in the wake of prices, a lot of buyers naturally found themselves on the sidelines. So you see that showing up. It basically, foot traffic declined until December. And then I think to a big surprise for a lot of people watching the market, foot traffic began to pick back up. And it started picking back up for several reasons. Number one, the number of new households, young people wanting to get into housing, continues to be robust. Number two, we've had almost 9 months of mortgage rates, somewhere in the 6 to 6.75%, 7% range. I think a lot of buyers are coming to terms with the fact that the sub 3% mortgages that we saw in 2021 are no longer here. They're not likely to be here anytime soon. So the question now moved from can I afford a house to how can I afford a house? And you're seeing that in the foot traffic, right? Instead of people just giving up, they're saying, okay, let me see what's on the market. At these rates, what do I qualify for? And let me go look at homes. To me, this is a significant change, as I mentioned, in the wake of these expectations of doom and gloom. This paints a rather resilient and, in my opinion, highly encouraging picture of the market this spring. And here's further context for you, right? Because we're talking about historical perspectives. When I looked at the March month numbers going back, 7 years, you see March 2023 on your right, compared to every March going back to 2017. What stands out to me, yes, we are slightly below the 2021-22 pandemic years, but as you and I think can probably agree, those years are highly unusual by any stretch, right? We don't have a global pandemic every year or even every decade, kind of the cadence for most economic recessions. These are really once in a generation, once in 2 generation events. So comparing ourselves to those years is almost unfair. So going back pre-pandemic, you can tell March of this year is substantially above in terms of foot traffic of 2017, 18, and 19, the pre-pandemic years. That again highlights how resilient today's buyers are. So far from dropping off the face of the market and just disappearing, they're trying to figure out how to make things work. And here's an important detail. What you see here is sort of the geographic distribution of the foot traffic index scores. And you can tell that the regions with high levels of affordability, think here the Midwest, think here parts of the Northeast, which are more affordable, are by far seeing a lot more buyer interest. The really expensive West region has the lowest index score, not surprisingly. And even the South regions, a lot of markets which during the pandemic saw huge influx of residents and also accompanied by significant price increases, are also seeing a little softening. So here's the big question for me. If these numbers are true and they basically are highlighting that buyers are back, what is driving this buyer interest? And here's my big takeaway for this is a strong job market provides a really solid foundation for housing this spring. And let me show you some numbers along those lines. So employment continues to remain strong. And this is, as I said, 9 months into the worry that, oh, we're going to hit a recession any month now. Employment remains resilient. The number of job openings, though getting smaller, is still significant, which tells me a lot of companies still need workers. And so what you see here, March, we saw 165,000 new jobs created. April, that number jumped to 253,000. And key to that number is the fact that most analysts and financial markets were expecting about 180,000 jobs in April. So the actual number of jobs outpaced expectations. Importantly, for me as an economist, but I think for the market overall, the number of new jobs are widespread across all sectors. With the exception of wholesale trade, we've seen new jobs in April created across the entire spectrum of the economy, whether it's hotels, restaurants, businesses, business services, financial services, information, manufacturing, and even construction saw job growth, a clear sign that even for home builders, they're recognizing that today's market is not the doom and gloom that many people expected, rather is one of opportunity. Also importantly, the unemployment rate drops to a 50-year low as of April, basically at 3.4%. I had to go look at the data back in time. Last time I saw 3.4 was May of 1969. A decidedly different environment, culturally, economically, and so on for the country. And the rate is well below the average that we've seen for the last roughly 70 years, right, around 5.7%. All of these point to an economy that's still resilient, and that's good news as far as I'm concerned for housing. We can chat about what that means for monetary policy, the Federal Reserve, and all those things, but for housing, the fact that we still have a strong market means people have a better chance at being able to afford homes. And here's another component of that affordability issue. Hourly wages in April also continued rising. They were up 4.4% compared to a year ago, outpacing the almost decade and a half average of about 3%. So to me, when we talk about affordability, it's important to remember, right, there are three components: prices, incomes, and interest rates. And at least while prices remain fairly elevated, interest rates remain elevated, incomes are also beginning to close some of that gap. So that is a real hopeful silver lining to some of the challenges. That being said, my next question, of course, after I say, hey, traffic is up, buyers are interested, how's this translating into transactions? What I'm seeing, and the data came out from the National Association of Realtors yesterday on existing home sales, we saw the market respond to the buyer traffic. You see in this graph towards the right, activity declined into January. Then February, we saw a rebound in the annual pace of home sales. But then that rebound has been gliding a little bit back down into March and April. The positive side of this is home transactions are still happening, meaning people are still able to buy homes. And I think even for doomsayers out there, the reality is in 2008-09, we still had about 4 million homes during the toughest period of that, the housing life. So the good news is home transactions are still taking place. And specifically, when I look at what's driving some of the declines in the last month, what I see here is, again, pointing to that foot traffic, pointing to high prices. You see the Western region really being responsible for quite a bit of that slowdown in sales, right? So a lot of buyers in the Western belt, California, Washington, some of the Oregon states, they are seeing some of the squeeze from the pricing and mortgage rates combo. So that's where you're seeing sales on a monthly basis and even yearly basis decline. What's driving that? Simply put, affordability. So it's worth pointing out that we have some good news. Buyers are out there and making deals happen. At the same time, the economic reality of high inflation still weighs on a lot of Americans. And so when I look at affordability, and this is data from National Association of Realtors going back quite a few years, what you see is affordability is at historically low levels. And again, going back to prices, incomes, and interest rates, that combination is really making it challenging for especially first-time buyers today. You see the 2008 through 2010, 2014 highlighted in orange. That's when the housing bust happened, when a lot of foreclosures hit the market. Naturally, affordability was really at record highs. We've come away from that period, but now we are seeing the reverse. So that's obviously putting a lot of squeeze on buyers. Mortgage payments, highlighting that in actual dollars and cents, are really highlighting this, right? You see the bar in red, that's October of last year. You remember that when average mortgage rates crossed the 7% threshold, right? After starting the year in January at 3, by October, they ended up at over 7.1%. We've pulled back from that, thankfully, but we're still around $2,000, really almost $1,000 more than just you know, a year and a half ago, when rates were a lot smaller, as well as prices. And here's, in a sense, what's also important to our discussion about underwriting standards. When you look at the median household income and compare it to the qualifying income that you'd need to afford a median priced home by region and nationally, you see this affordability highlighted again very sharply by geography. So in the US, and those are the blue bars, the median household income is somewhere around $91,000. The qualifying income to afford the median priced home is a little over that, about $1,000 more. But when you look geographically, what you see is the West region. Once again, high prices are really driving this lack of affordability, is really standing out, right? Your qualifying income is in excess of $140,000 for a median priced home, and yet incomes during, you know, in that area are not as strong. So some of that, of course, if that were in a sense improved, you would see a different picture across the country. The Northeast, the Midwest, similar to what we saw in foot traffic, are much better positioned, right? So the kind of salary or wages you need in those areas are much lower than the median income. So not surprisingly, that's where you're seeing a lot of activities, transactions, and buyer interest. So with that, I want to take a little bit of a look forward and highlight what to me is a promising development this year for the economy as well as housing, and that is inflation. We have all experienced this last year's real sharp ramp up in prices. Everything from cars, whether new or even used, to clothing, to food, to gasoline, utilities, daycare, you name it, has really gone up to a pace, especially midpoint of last year, pace we hadn't seen since 1980s. And we've been talking for well over a year now about the impact this has had both on us as consumers, but also on real estate markets. The good news for me here, this inflation has been moderating. We saw as of April, it basically got to about 5%, 4.95%. The Fed's tightening through rate increases, through balance sheet reduction, have begun to really have a noticeable effect. The challenge here is, even with that slowdown, you can tell inflation remains well above the average we've seen over the 1983-2023 period, so 4-decade period of 2.8%, and still noticeably higher than where the Fed would like to see it, roughly around 2%. But we're moving in the right direction. And importantly, we are seeing some signs of let up on some of the goods and services we've really paid a sharp increase for. Whether it's used cars and trucks are actually seeing a pullback. That to me is good news. Utility gas prices are coming down, fuel, oil, and this is really, I know, very much on the radar for a lot of homeowners and home buyers in the Northeast, New England area, where fuel oil can make a real dent in household budgets every winter. And of course, gasoline, we've seen come down, but a lot of other services and goods still continue to rise, and I think that will continue to weigh on the economy. Here's the real promising part of this, however. What you see here is the average 30-year fixed rate, as Freddie Mac tallies it every week, compared to the consumer price index, one of the measures of inflation, going back all the way to roughly the mid-1970s. The reason I bring it up is you can tell how the two of them, mortgage rates and inflation, tend to move in tandem with the lag. By lag, I mean mortgage rates respond down, a few months to the changes in inflation. You see, in the 1970s, when inflation ramped up significantly, so did mortgage rates, right? They shot up towards 18% of that or so. I remember people still telling me, hey, I bought my house in the 1980s with a 16% mortgage rate. So these rates are not bad. True, home prices were a little cheaper then as well. But then you see,
Sure
as
were.
inflation moderated, you see mortgage rates also do similarly. And now look all the way to the right on this graph. You see the green line, inflation really shot up last year. It's been on a downward trend. Similarly, the mortgage rates, with a slight lag of a few months, also began to increase. And now, if the current pace of inflation continues to slow, we can expect mortgage rates at some point, possibly later this year, to also show a slight retreat. I don't think they'll go anywhere near the 2.5% some people have already on their home, but I do see this as a real promising development in the months ahead for housing. So with that, Johnny, the only thing I'll leave my presentation with is just a web address where folks in the audience can get a lot more information. And glad to chat with you about any of this.
So that was a lot to unpack and a lot of good information there. It was interesting to see the Northeast. I'm in New Hampshire and Maine. So it was interesting to see that, because I sit here and say, oh my God, prices are ridiculously crazy. Which they are in some areas. And, we're still getting multiple offers. I heard of a property a couple of weeks ago in New Hampshire that had 30 offers on it. So that's a little crazy. It's not uncommon to get 5, right? So that's still happening around here. So when we look at that, but it's still, if you're willing to go into certain pockets, it's like anything, the closer you are to the metropolis, the more expensive things become, right? But Maine is a big city, and if you can get into some areas, you can still find yourself a decent property that's affordable, right? So it was real interesting to see those facts and the foot traffic. And interesting about the foot traffic was that it's still considerably high. It might be lower than the pandemic years, but is that what we call them now? The pandemic years? That's like the wonder years, the pandemic years. We'll have to make a sitcom about that in the future, but it's still higher than it looked, even still higher than when we had the boom going on years ago. So that's all a positive thing, I think. Taking a look at this, taking a look at the correlation between the interest rate and interest and such like that, and seeing how they more or less run in tandem with one another. I would anticipate we can see some level of easing on the interest rates. I don't think we'll get back down to that low rate like we did, that people so thoroughly enjoyed. It'd be great if we do. That'll make the market boom once again. Which that side isn't good for anybody either, right? We want to find that balance right in the middle. That's good for both consumers, buyers and sellers. What else are you seeing out there? You seeing anything in the economic world that has any indicators that there might be trouble on the horizon or smooth sailing ahead? If somebody was worried about what the next year is going to look like in real estate, do you think it's, hey, listen, it's smooth sailing with little bumpiness? Or, hey, listen, buckle up and shed the dead weight? What do you think?
So that's an important question, Johnny, for so many people, including homeowners who may be, due to life circumstances, life stage changes, looking to move, right? And they are facing, to your point, this very real quandary over the house I'm about to buy might be more expensive and the rate is double what I have. It's also important for so many first-time buyers who are looking at this market saying, okay, we've had some highly unusual, you call it even slightly crazy years, the last 2.5 or so. Is there any hope for me in the market? So my view here is somewhat nuanced, and I'll put it this way. I do see a market that's going to continue to have interest, to have transactions. As I already mentioned, even young people today see the value in home ownership. Beyond just having a place of your own, they see the wealth building effect. So I think that's a real tailwind in the sales of real estate. On the economy side, we do have some risks. Number one, we still have a Federal Reserve that is, as a central bank, focused on taming inflation. And they're doing so mostly through either hiking the short-term interest rate. So it's sort of a baseline instrument in pushing borrowing costs higher, and we've seen that. And they're also pulling back from some of the direct loans they've made, their balance sheet. They're not buying as many treasuries, not as many mortgage-backed securities. All of these are weighing both on the economy and housing. So here, the big concern has been the last roughly 9 months. This action is going to push the economy into a recession. So far, we're not seeing it. But at the same time, it doesn't mean that economic softening couldn't happen, right? So that is the one thing I watch out for, and specifically for real estate. That's why I keep such a close eye on the jobs market. As long as people have jobs, as long as their wages are growing, they're in a better position to weather a slowdown or even an expensive market for the time being. At the same time, when you see that unemployment rate begin to tick up as people might lose jobs, that could be a turning point signal. For now, I'm not seeing that. So that's why I'm cautiously optimistic for the rest of the year. But that doesn't mean that we don't want to keep our eyes open. So bottom line, the way I look at this, we've spent 9 months listening to people tell us the recession is coming, the housing is going to crash. Every month I pay attention to data coming in, and every month what I'm seeing is an economy and an American public that's a lot more resilient than a lot of these fears. So if anything, that's what gives me a lot more confidence about the remainder of this year.
What's really good about listening to you and sharing this real raw data is there is no political bias to it. If you go to CNN, they tell you one story, you go to Fox, they tell you another story. So it's almost impossible to come up with a true conclusion based upon the data feed that you're receiving from these places. But to see the unemployment rate at 3.4%, I thought the unemployment rate was higher. 3.4% is historically great, right? Is absolutely historically great. So I know there's some conspiracies that can be rolled into that, oh, people came off of this plan or low income jobs or whatever. The fact is it's still 3.4%. So that's good. This is all good data. And listen, you guys came out not too long ago with an app. And on this app, you're able to take some of this information or prescribed scripts and things like that and be able to tell this story and articulate it so you sound educated, so you look good, so you're not stumbling around with what to say. And I know that's an uncomfortable place for a lot of us. I own a video production company. I know I help people with it every day. I struggle with it. Right. So I know, so being able to read the bouncing ball, that's a real fun and easy thing to do. But I do believe that in this day and age, Gary Vaynerchuk said it in 2016. You need to think of yourself as a media company, not just a real estate agent. People can take this information, join KCM. It's $1 a day, right? It's $1 a day at the end. I don't even know if it's $1 a day on some months, right? But it's very inexpensive to be able to get this data where really smart people collect it, they disseminated it, and then they're able to present it in a way that you can articulate it and understand it as the individual. So with that app that you guys offer, I know that that's an additional thing, rightfully so too. Agents can do that. Agents can also go to the website with the daily blogs or the information that you guys are providing on the subscription. Heck, not even on the subscription side, but on the subscription side, you get more stuff. But you're able to go in there and make these videos talking about this information. Not disinformation, this information, TITHIS. Because there's so much misinformation and disinformation out there about the housing market, and the majority of it is designed to elicit a click, right? If somebody clicks on that web page, they did their job, because there's a metrics out there that they base their whole success on: clicks and retention and all these other things. Their job is to get people to click. And so you're able to come out there, and some of the best videos that I have on TikTok, most of my videos about food or going on hikes in Maine and cool oceanside things that I find, but the videos that I do about the housing market get excellent response. And the people who are responding to that follows Gary Vaynerchuk's jab, 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 right hook, where I'm talking about these things. I'm showing these really cool things. Now, all of a sudden I come in with the real estate stuff. If I'm just always real estate, I kind of will blind the people and tune them out. But if I come in, jab, 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 right hook, every third post is about real estate. This is just a way that I think every real estate agent in the world should be. They're not, and they won't, but I think they should be taking this information and then explaining this information, not only just this information, guys, but also the information that you're getting from your MLS or your associations. My association sends out a monthly newsletter that has all the market updates for all 20, I think we have 26 counties. For all 26 counties, I go in there, I take out the information I want to talk about, and I talk about it. You can do that too. That's another piece. But if you're putting out a good article once per week, a blog article, a video with that, with all of this information, you would be the most knowledgeable agent in your area, and people would want to work with you, right? People would want to work with you. How do people, you put up the website there a minute ago, people can, if you don't have KCM, you can go ahead and get it and get it for free. Try it out. If you don't like it, cancel it, but you're going to love it. You just go to trykcm.com. You had something after yours though, MMC or something like that.
That was for a monthly market report, and members can look at that. And right now we have that at a national level.
Mm-hmm.
And our focus is to also provide more insights on a monthly basis at the local level, right? Because as you know, as people listening in, so much of real estate is really driven by local trends. So it's good to know what happens nationally, but at the same time, to your point, New Hampshire, Vermont, Maine, right? The New England markets today, this year, are behaving very differently, right? A lot of people have moved into those areas from other parts of town in the country in the last 3 years. You're seeing the impact of remote work, right? From Boston, the Boston Metro, on a lot of the states in that region. So there, the market dynamics are very different than in other parts. So to your point, one of the main focus areas for KCM is to provide agents with timely and accurate insights at both the national and local level. So right on that one.
That's awesome. trykcm.com/MMR. I just brought it up. It looks pretty cool. Listen, if you're not doing it, if you're not going to do these videos, your competition will. That's the way. Do you want them seeing you? Or do you want them seeing your competition being the most knowledgeable and respected real estate agent in your market? Anyways, George, we are out of time and Jake is going to yell at us. So I want to thank you for being here. George Ratiu, Chief Economist of Keeping Current Matters. Thank you for breaking this down to an understandable level for us.
I appreciate the invitation, Johnny. Anytime.
Thank you all.